We've all been there, grinding away at work, obsessing over the numbers in our bank account, constantly worrying if we're doing enough to secure our financial future. But here's the harsh truth. For many of us, even working hard every day still doesn't guarantee we can afford a home, especially in 2026. The reality is prices are soaring, and the landscape of homeownership is changing faster than ever. Imagine this. You've been saving diligently, cutting back on unnecessary expenses, but when it comes time to make that big purchase, the home of your dreams, you're left wondering if it's all enough. What's going wrong? The average cost of a home in the United States is reaching record highs. In some areas, it's not unusual to see homes pushing $500,000 or more, and with interest rates fluctuating, the dream of owning a home feels like it's slipping further away, even for those who are financially responsible and budget conscious. So what's the real deal? Is home ownership in 2026 just a pipe dream for the average person? Or is there a path to actually being able to afford a house without sacrificing everything else? That's exactly what we're going to break down in this video. Before we get into the numbers and all the variables that could impact your ability to buy a home in 2026, let's take a step back and think about the way most people approach this problem. We're often told that we have to work harder, save more, and do whatever it takes to make it. But is that the real solution? You see, most financial advice puts the pressure on working harder and earning more, without truly examining the bigger picture. You get stuck in a cycle of constant hustle, unable to take a breath or even enjoy the little things in life. But what if building wealth, specifically the kind of wealth that can support a home purchase, doesn't require burning yourself out? What if it's more about working smarter and understanding the systems that can actually help you get ahead without putting everything else in jeopardy? That's the first key question we need to answer before we can really dive into whether or not you can afford a home in 2026. The shift in thinking, building wealth while living life. When most people think of financial independence or home ownership, they imagine a long, grueling road of sacrifice. Long hours at work, stress over every dollar, constantly checking your bank account for signs of progress. But the real question is, why does it have to be this way? Here's the thing. Wealth isn't built by sacrificing your happiness and well-being. In fact, the wealthiest individuals in the world aren't working harder than everyone else. They've figured out how to automate their wealth-building processes so their money works for them while they focus on the things that matter most in life. Let's talk about this for a second. If you're tired of feeling like you're on a never-ending hamster wheel, the solution doesn't lie in grinding harder. It lies in systems. Systems that automatically work in the background to grow your wealth while you're living your actual life. And that's exactly how people are building financial security, without the burnout. Now let's think about that for a moment. What would it look like if, instead of obsessing over every dollar, you were able to set up systems that work for you? What if your financial success was automatic, so you didn't have to constantly worry about every decision? That's what we're going to explore as we look at the path to home ownership in 2026. Affordability, a critical look at the numbers. We need to talk about the cold, hard facts. Affordability is the key challenge for most people trying to buy a home in 2026. In this part, we'll break down the factors that contribute to the challenge of home ownership: mortgage rates, home prices, and income levels. First, let's address mortgage rates. With the current trend of rising rates, even the most financially savvy homebuyer could be feeling the squeeze. In 2026, interest rates are expected to stay high, making monthly mortgage payments more expensive than they've been in recent years. Next, let's talk about home prices. The median price of a home in the U.S. has been climbing steadily, especially in metropolitan areas where job opportunities are concentrated. That means if you're looking to buy in a competitive market, the house you want might be out of your financial reach. But here's the most important piece: income disparity. While wages are growing, they aren't growing fast enough to keep up with the rise in housing costs. This means that many people are being priced out of the market, or at least pushed into less desirable locations or smaller homes than they had hoped for. So does that mean it's impossible to afford a home? Absolutely not, but it does mean that the approach you take matters more than ever. Let's now talk about how we can set realistic expectations, navigate these challenges, and still find a way to make homeownership a reality for 2026. We've talked about the challenges of affordability, but the good news is that there are actionable steps you can take to break through these barriers and position yourself for success in 2026. The first thing you need to understand is that while the housing market is challenging, it's not impossible to buy a home. You just need the right approach and a clear strategy. One of the most important steps in overcoming the affordability issue is to build a strong financial foundation. If you're serious about buying a home in 2026, this means you need to start by evaluating your current financial health. Are you carrying high-interest debt, like credit cards or personal loans? Are your savings on track, or do you need to boost your emergency fund before thinking about a down payment? The reality is, your credit score, savings, and debt-to-income ratio are going to play a huge role in determining whether you can afford a home in the coming years. Start by addressing your debt. The high-interest debt you're carrying is one of the biggest roadblocks standing in the way of your financial progress. If you're putting your money toward paying off high-interest loans, it's much harder to save for a down payment or invest for the future. Focus on paying off those debts as quickly as possible, using methods like the debt avalanche or debt snowball to eliminate the highest interest debts first. Once that burden is lifted, you'll have more freedom to save for a home. Next, let's talk about saving for that down payment. The more you can put down up front, the lower your monthly mortgage payments will be. Start by setting a concrete savings goal based on the price range of homes you're considering. If you want to buy a $400,000 home, for example, a 20% down payment would be $80,000. I know that sounds like a lot, but don't let that scare you. If you break it down into manageable chunks, it becomes much more attainable. Start by automating your savings. Take a set percentage of your income and have it directly deposited into a savings or investment account each month. This way, you don't even have to think about it, and the savings build up over time. But it's not just about how much you save, it's also about how you save. You need to look at your savings with an investment mindset. Putting your money into a high-yield savings account or a low-risk investment option will allow it to grow while you're waiting to buy your home. While interest rates on savings accounts have been low in recent years, the growth of your savings doesn't have to stop with just your paycheck. Make sure that money is working for you by exploring investment vehicles like mutual funds, ETFs, or even real estate investment trusts, REITs, that can give you better returns over time. Another crucial step is to improve your credit score. Your credit score can determine the interest rate on your mortgage and whether you're even approved for a loan in the first place. If your score is low, start by checking your credit report and addressing any errors. Pay down outstanding debts and avoid applying for new lines of credit in the short term. Building a strong credit history will pay off when you're ready to buy a house in 2026. Keep in mind that mortgage rates are influenced by your credit score. Lower scores often mean higher rates, which can cost you tens of thousands of dollars over the life of your loan. If you're currently renting, it's also a good idea to start looking into the rental market to get an idea of what you can afford. While it might seem unrelated, knowing what you can afford to rent in the next few years will help you determine what kind of mortgage you can realistically handle. Many people make the mistake of thinking they can afford a higher mortgage than their rental payments. But the truth is, a mortgage comes with a lot of hidden costs, property taxes, insurance, maintenance fees, etc. So living within your current means and avoiding lifestyle inflation is key. Now let's talk about one of the most important factors for first-time homebuyers, getting pre-approved for a mortgage. This is often overlooked, but it's crucial for understanding how much home you can truly afford. A pre-approval not only gives you an idea of the loan amount you'll be eligible for, but also strengthens your position as a buyer. Sellers want to know that you're a serious buyer, and being pre-approved lets them know you've done the work on your end. But here's the catch. Just because you're pre-approved for a loan doesn't mean you should stretch your budget to the limit. Stay conservative and consider your long-term financial goals. The last thing you want is to get house poor, where all your income is going toward the mortgage, leaving little room for savings or other financial goals. By following these foundational steps, you'll be in a much better position to buy a home in 2026. It won't be easy, but it is possible. The key is to take it one step at a time, focusing on your credit, debt, and saving strategy. Now that we've covered the basics, Let's dive deeper into how automation and smart financial systems can help you make steady progress toward homeownership while minimizing stress. In the next part, we'll explore how you can automate your financial journey to make wealth building feel effortless. Stay tuned. Let's face it, life is busy. Between work, personal commitments, and everything in between, it's easy to let your financial goals slip through the cracks. That's why automation is one of the most powerful tools you can use to build wealth and ultimately afford a home in 2026. Imagine this. You don't have to spend hours every week obsessing over your savings, investments, or budget. Instead, everything happens automatically, quietly working in the background while you focus on the things that matter most to you. So how do you create this kind of automation in your financial life? It's simpler than you might think. The first step is to automate your savings. This might sound basic, but trust me, it's one of the most effective ways to ensure that your savings goals aren't left up to chance. Once you set up automatic transfers from your checking account to your savings account, it's no longer something you have to think about. You won't even notice the money leaving your account because it's happening before you have the chance to spend it. You simply decide how much you want to save every month, and your bank does the rest. You can also use automation to set up direct deposits into investment accounts. Whether it's a retirement account, a brokerage account for stocks, or a real estate investment fund, make sure that a portion of your income is automatically being funneled into investments. This helps you build wealth steadily without needing to consciously make the decision each month. And the best part? You'll be able to enjoy compound interest working in your favor without even lifting a finger. But here's the big question. What happens if you have an emergency or something unexpected pops up? This is where having an emergency fund becomes essential. By automating your emergency savings, you can ensure that you're always prepared for life's curveballs. Aim to have 3 to 6 months worth of expenses set aside in an easily accessible account. When it's automated, you won't have to worry about finding the money or thinking about it at all. It's already there, growing quietly in the background, ready for when you need it. When it comes to building a home down payment, the automation process works similarly. First, decide on a goal. Maybe you're aiming for a 10%, 15%, or 20% down payment on your home. Once you have that number in mind, break it down into manageable monthly or bi-weekly amounts. Then set up an automated transfer from your checking account into a separate savings account specifically for your home down payment. With each paycheck, that money is automatically flowing into your home fund, and you're one step closer to your goal without having to lift a finger. But here's where most people get stuck. They start using automation, but they don't follow through. They set it up for a few months, then let the system go to waste. The key here is consistency. Automating is a great first step, but you also have to commit to it for the long haul. Just like in any wealth-building process, consistency is crucial. The goal is to create habits that keep you on track, even when life throws you off course. Automation also eliminates the temptation to spend money that you should be saving. Many people are in a constant battle with themselves over whether they should save or spend, and this internal struggle can derail even the best financial plans. When your savings and investments are automatic, you no longer have to make that decision consciously. You're already building wealth, whether you think about it or not. This principle applies to your debt repayments too. If you're still carrying debt, especially high-interest credit card debt, automating your debt repayments is a game changer. Just like your savings, set up automatic transfers to pay off your debts. You'll feel the psychological relief of knowing that your bills are being taken care of without you needing to constantly remind yourself or worry about making a payment on time. But here's the best part. As you automate your finances, you'll begin to notice a shift in your mindset. You'll start to see money as a tool that works for you, not something you constantly have to chase. As automation takes the decision-making process off your plate, you can start focusing on other aspects of your life, your career, your relationships, and your well-being. By setting everything on autopilot, you'll feel a sense of control and relief that allows you to focus on bigger picture goals. And that's exactly what you need if you want to buy a house in 2026. Peace of mind and a system that works for you in the background. So let's recap. What do you need to do to afford a home in 2026? First, you need to get a solid handle on your finances, reduce your debt, save consistently, and automate as much as possible. The power of automation, combined with a clear savings plan and debt reduction strategy, will put you on track to achieving your homeownership goals. But we're not done yet. In the next part, we'll dive into how to start investing and building wealth through passive income. It's time to start making your money work for you, and we're going to show you how. Now that you have your financial foundation in place and your savings are working automatically, it's time to take things to the next level. This is where investing and passive income come into play. The goal here is to make your money work for you so that, over time, your wealth compounds without requiring constant effort on your part. Let's start with the basics of investing. While it can seem intimidating at first, investing doesn't have to be complex. In fact, for most people, the most effective way to grow wealth is through index funds and ETFs, exchange-traded funds. These are investment vehicles that track the performance of entire markets, like the S&P 500. Instead of trying to pick individual winning stocks, which can be a risky and time-consuming game, you're investing in a broad array of companies, spreading your risk while still capturing growth. The beauty of this approach is that it requires very little time or effort. Once you've set up your investments, you don't need to track the market daily or worry about individual stock performance. Instead, you're simply letting the market work for you, using the power of compound interest. Compound interest is a powerful force that allows your money to grow exponentially over time. The longer you let it sit, the more your wealth will increase. Let's put this into perspective. Imagine you invest $10,000 into an index fund that averages a 7% annual return. After just 1 year, you'd have $10,700. It doesn't sound like much, right? But over 20 years, that $10,000 grows to nearly $40,000, just from the magic of compound interest. If you continue contributing to your investment regularly, you'll see even more significant growth. This is the true power of investing. It doesn't require a lot of active effort, but it builds wealth consistently over time. But you might be asking, how do I start investing if I don't have a lot of money? The good news is you don't need a huge upfront investment to start seeing the benefits of compound interest. Many brokerages allow you to invest with as little as $50 or $100 a month, making it accessible for almost anyone, regardless of income level. The key is to start early and stay consistent. Now let's talk about passive income, which is the real game changer for building wealth without burning out. Passive income refers to earnings you receive with little to no active effort. This is the money that keeps flowing in the background while you sleep, while you're at work, or while you're enjoying time with friends and family. One of the most popular ways to build passive income is through dividend investing. Dividends are payments made by companies to their shareholders, usually on a quarterly basis. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have long histories of paying dividends to their investors. By purchasing shares in dividend-paying stocks, you can start receiving regular income without lifting a finger. Let's break it down with an example. Suppose you invest $10,000 in a diversified portfolio of dividend stocks with an average yield of 3%. That's $300 in passive income every year. The real magic happens when you reinvest those dividends back into buying more shares, which generates even more dividends. Over time, this creates a snowball effect, and before you know it, that $300 a year could turn into thousands of dollars of passive income. Another form of passive income is real estate investing. While it requires more capital up front, real estate can be an incredibly lucrative source of passive income. Think of it this way. When you buy a rental property, you're essentially letting someone else pay off your mortgage while you enjoy the benefits of appreciation in property value. Once you've set up the property and found tenants, the income becomes largely passive. Yes, there's some management required, but compared to the effort of a regular job, it's a much more hands-off way of building wealth. Real estate investment trusts, REITs, are also a great way to get exposure to real estate without having to buy physical property. REITs allow you to invest in a diversified portfolio of real estate assets, and they often pay high dividends, making them an excellent source of passive income. Now you might be thinking, okay, this all sounds great, but I'm still in the early stages of saving for a home. Don't worry, investing in the stock market and building passive income doesn't need to wait until you have the full amount saved for your down payment. Start small. Even if you only have $100 a month to invest, it's important to start somewhere. Over time, that money will grow, and you'll find yourself in a much stronger position when you're ready to buy a home. But here's the key. Be patient. Building wealth through investments and passive income doesn't happen overnight. It's a long-term game, and the earlier you start, the more you'll benefit from compound growth. Now let's talk about one final point that can supercharge your ability to afford a home in 2026. Tax optimization. As your wealth grows, you'll want to be mindful of taxes. The more you make, the more you'll pay in taxes. However, there are ways to minimize your tax burden through smart strategies, like maxing out tax advantage accounts. Accounts like your 401k, IRA, and health savings account, HSA, allow you to contribute money before it's taxed, reducing your taxable income for the year. Additionally, any growth in these accounts is tax-deferred or even tax-free, depending on the account type. This means you can invest more money toward your future without losing a significant portion of taxes. By taking advantage of tax advantage accounts and other strategies, you'll be able to save more and build wealth faster, getting you closer to your goal of homeownership. At the end of the day, the path to affording a home in 2026 isn't about working harder or burning yourself out. It's about setting up systems that automate your wealth-building efforts, investing smartly, and generating passive income that works for you. You don't have to wait years of grinding to get ahead. By leveraging these strategies, you can make progress toward your homeownership goal while living a life that's financially free and fulfilling. If you found this video helpful and you're ready to start building your path to homeownership in 2026, be sure to hit that subscribe button and turn on notifications. Let's continue this journey together and make sure you're set up for financial success. Your future self will thank you.